I don't think it will happen in September. I'm still holding on to one in December of this year. But right now, I think based on the inflation numbers, it would be very difficult to raise in September on a credible basis.
David, would you agree with what Ward has just said?
I would agree with a lot of his comments about commodities in particular. With respect to the Fed, I think he makes a valid point that as commodity prices continue to fall, it's going to make it more and more difficult for the Fed to reach that 2% inflation target and have a reason for hiking rates. I, too, am still in the camp that we will see a move before the end of the year, but I think just one hike before the end of 2015.
The biggest concern we have, Simon, is that there's such a disconnect between where fixed income markets think the Fed will raise rates and when, and what equity markets believe. Fed funds futures discount a 0% chance of September move, where most equity market participants think the economy is strong enough to take that move in September. So we're worried about the miscommunication and misdirection of interest rate policy versus market expectations against the backdrop of fairly high valuations, low earnings growth, and the VIX, which is now at the lower end of its annual band.
Piece of it just comes from a lot of the commentary we heard last week. When the China market saw the volatility that it did, there was a lot of concern there could be shockwaves on the consumer side. But actually, this week it's a little bit different. We're actually seeing a number of reports from the Taiwanese supply chain where a number of companies are actually talking about smartphone weakness in Q3, and they're guiding lower. One of them was actually Synaptics, who is a big customer of Samsung. But there are a number of smaller Taiwanese companies that don't trade in the U.S. that are making a lot of cautious comments about smartphones generally. But my view is that a lot of the weakness they're seeing is coming from Samsung, who we know is seeing lower. We don't know, but we believe they're seeing lower orders in the supply chain from Q2 to Q3. And a number of the China smartphone OEMs have seen growing inventory. And so we think that they're also have been cautious with their orders as well. And we think that because of the volatility in Asia, that a number of investors are extrapolating that back to a potential impact on Apple.
A rotation, leaving some of the delta or the high volatility on the table, getting out of the names like an Apple, because Apple suffers from its own success, if you will. What have you done for me lately? Or the old axiom on Wall Street, buy on the rumor, sell on the news. They've delivered the numbers. We've gotten some reads on their product sales, and now the stock is coming under pressure. And again, as I alluded to earlier, 11% not a big deal. But I think what we're actually seeing is somewhat of a rotation out of some of the larger S&P names, if you use the safe haven, if you will, from that side of the equation, and continue to look for value in the Russell 2000 and the S&P 500. We still consider seeing buying interest in the restaurants today. Yeah. I think that's going to continue.